Welcome back into Thimbleberry U. I am John Jagay. I'm joined by Amy Walls from Thimbleberry Financial. Amy, always good to be with you.
Jag, it's great to talk to you.
So we're talking about part of the American dream today, and that, of course, is owning your home. And we're going to talk about whether or not it's a good idea to have a mortgage in retirement. We were talking offline, Amy, that this is the topic you wanted to cover today. What prompted this?
Yeah, it's really a question that comes up fairly regularly as people think about being financially independent or retired. And I should probably pause after using those two terms and just take a second to define them.
Sure. Financially
independent, as I look at it, is the day you wake up and if you go earn a paycheck or not, it's completely a choice.
Okay.
You don't need to go earn a paycheck, but you may choose to. Retired is more the traditional, I'm now done working, I don't expect to work going forward definition.
Got it.
So this comes up in a couple of different situations that I will talk about, but it's interesting to note that nearly 38% of U.S. homeowners age 65 plus have a mortgage. And this information came from an article in Forbes in October of 2021.
Okay.
So you mentioned the American dream. You know, it's owning a home, but it's also owning a home that is paid for.
Right.
So the reality is this dream is not happening consistently. If 38% of U.S. homeowners age 65 plus still have a mortgage.
Yeah, that's true. People have these dreams of retirement, and we see in a lot of cases, it's not what they thought it was going to be or hoped it was going to be.
Yeah, absolutely. So I think the question, though, that this brings to mind and that we ultimately want to answer is, should it be part of the dream to have your home paid for? Or is that dream of having your home paid for actually hurting people?
I'm going to guess this is where you go for your tried and true line of it depends, right?
You know me too well. So, yeah, we'll talk pros and cons, I think, today about this. But let me give you a few examples of when I hear this come up most often. Mm-hmm. One is when we have new clients and, you know, it's early in our relationship and it's just one of the things that they've always envisioned about retirement is that I'm not going to have a mortgage. And when I hear that, I tend to dig in and ask questions.
Okay.
About where that comes from, what's creating it. Is it really a value they have, or is it something they think they're supposed to do and that it will make retirement better? And most of the time, the answer is that they think they're supposed to and that it will make their retirement easier.
Whether that came from their parents or societal norms, peer pressure, whatever that is, right?
Yep. And most often what it drills down to is people have tried to envision how they're going to have income come in retirement. And they know they have to draw down on their accounts. But what they're thinking is, if I don't have a mortgage, I don't have to draw down as much on my accounts every month. So automatically that's going to help me.
Okay, that makes sense.
It's how they can envision recreating a paycheck more easily.
They may not have that weekly or monthly thing coming in from an employer, but it kind of offsets that by not having this giant mortgage payment every month.
That's what they're thinking. It's just easier to wrap their heads around. So it's academic and it ends up being emotional for them.
Sure. Yeah. Okay.
The other place where this comes up is with our longer term clients who've had a change in their situation. Mm-hmm. So let's say, for example, they've just received an inheritance and a home is part of that inheritance and it is paid off.
Okay.
And maybe that home has memories and they're thinking about moving into it and selling their existing home. There's an automatic assumption, well, because that house is paid off, I'm going to be better off than I am having my current home that has a mortgage.
I see where that mindset comes from.
And it's not always the case.
Okay, so let's get down to brass tacks here, Amy. Does paying off a mortgage help achieve a more successful retirement?
Well, let's define successful.
Fair enough.
Okay, I'm going to say that successful means that you're getting out of life what you want out of life and not running out of money.
Okay, that's fair.
Okay, because I think there's a lot of different ways to look at it. And the way we approach planning is always, and helping a client is always about what is it that they want to get out of their life. So earlier you said I was going to use my tried and true answer of it depends. And that's the case here. Sometimes a mortgage can be helpful in achieving a successful retirement. Sometimes it may not be.
So, Amy, let's break down both sides of this, and we'll start on the positive side. When can paying off a mortgage help you have a successful retirement?
It's when someone has more than enough money, they're financially independent, they're going to be okay, and proportionately, enough of that money is in taxable accounts. And by taxable accounts, I'm really referring to bank accounts or brokerage accounts.
Okay.
When someone has a high interest rate on their loan, right, then it's going to make sense. If this were the 80s, well, then it's going to make sense to pay off that mortgage.
Right.
When they have a really short investment time frame, that might make more sense.
Meaning
the time value of money of doing something different with the dollars that would go to pay off the mortgage is short.
Okay.
And that's just because you don't have the chance for compounding interest on investing the dollars instead. So therefore, it may be better to pay off the mortgage. It can also help when it's financially feasible. Okay, it doesn't necessarily fit any of these definitions, but it is financially feasible and it will bring someone peace.
That's big. Yeah.
It is. Financial planning and wealth management, it's art and science or science and art, whichever way you approach the particular question. And when mathematically it doesn't make sense, but it's going to get someone the calm and peace that they would like in life to enjoy the rest of their life more, if they can afford it, it doesn't hurt.
And a little bit of a teaser when we're talking about mindfulness in our next episode. Okay, other side of the coin, Amy. When can paying off a mortgage hurt your chances at a successful retirement?
Yeah, definitely when you're not financially prepared for retirement or financial independence.
Okay.
An expression I've heard is you can't eat your home.
I like that. Okay.
Right. So paying it off just means you have less liquid money. Another place where it might not help is when most of your investments or savings is tax deferred. So in IRAs, and you don't have adequate tax diversification.
Okay.
And the reason there being that those taxable accounts, the tax diversification provides flexibility.
Right. Okay.
Around how you pay for different expenses. And if you were to pull money out of an IRA to pay off a house, well, your tax bill just went up.
Mm-hmm.
So that likely isn't going to make sense. And so the taxable accounts are where that money would come from. But if you spend all of that to pay off your mortgage, well, then you've just decreased your tax flexibility and flexibility for life for anything financial going forward.
Yeah.
Paying off the mortgage may not be beneficial when you have a low interest rate on the loan.
Sure.
And your risk tolerance and long-term investment horizon would allow you to get greater growth on the investment, which ties to also a longer investment time frame. Another place where it might hurt is if someone has plenty of savings and is committed, I might say dead set, on not drawing out of retirement accounts until they are of required minimum distribution age, which is now 72.
Right.
So sometimes what we see is having a mortgage and sometimes even an earlier retirement date may actually help them behaviorally from a distribution standpoint, as long as they're willing to pull money out of IRAs early so that the tax bill doesn't get as big down the road. So sometimes the mortgage is what will push people over the edge to actually make those distributions earlier so that they can keep more of their money because less ultimately goes to pay taxes. So it's a behavioral tool at that point to get them to make the right choice.
Got it. You're comparing a lot of different things, and it goes back to your comfort level a little bit. Yep.
And then another one would be if you're planning to buy a second home. So maybe it's for you, maybe it's for a child, but you're better off with that mortgage being on the primary residence because you're going to have lower interest rates and lower fees than if it's on a second home.
True. Okay. So that's kind of both sides of whether paying the mortgage can help or hurt your retirement. Let's dig a little bit deeper now. When does it actually make sense to pay off the mortgage?
First, you just have to have plenty of assets for retirement. You absolutely have to know you're on track. It's going to make the most sense if the money that you are going to use to pay off the mortgage is sitting in cash versus being invested. And if paying off that mortgage is going to provide that peace of mind we talked about earlier.
Yeah.
Like I said, most of the desire I hear from clients we talk to pay off a mortgage is about the ease of recreating an income stream and just ensuring that the money's going to be there to make those payments. And that's an educational component of understanding there's a different way to have that money come in and consistently have the mortgage paid off, and it doesn't have to be a stress.
Okay, so what are some of these considerations for someone considering if they should pay off their mortgage?
I think it's, what is someone going to gain from paying off the mortgage? One, they're going to get less debt. That can feel great. They're going to have smaller payments or less payments, maybe no payments. That's a great feeling.
Yep.
And they're going to have more freed up cash flow because they don't have those payments. So sometimes the logic is, I get it paid down, now I can save more. Mm-hmm. Right? If they're talking about paying it off before retirement.
But on the flip side, there's going to be stuff they give up, right?
Absolutely. So what they're going to give up is growth on the invested money, that compounding interest I talked about earlier. Mm-hmm. They're not going to get any further interest deductions on their tax return. Now, sometimes people make a really big deal out of that. It can play a role, but I don't think it's a make or break situation.
Okay.
But I think the big thing that they're going to give up is they're going to give up liquidity and leverage, which those two things together are flexibility.
Right.
And Jag, we've been recording podcasts together for quite a while. And outside of it depends as an answer, I think the other thing that probably jumps out that I tend to focus on is flexibility. We don't know what life's going to throw at us.
The last 2 years are a pretty good indication of that.
Absolutely. So that flexibility is huge. And to not have the liquidity any longer in terms of having access to the assets because they've been used to pay off the mortgage just decreases that.
Sure, absolutely. All right, so we've kind of talked about the two extremes here, Amy, of not paying off the mortgage and making your regular payments, then, of course, paying the whole thing off. But I got to imagine there's a middle ground, too, and that's making extra payments and paying off the mortgage a little bit early. What are your thoughts on that?
Yeah, there's nothing wrong with doing that. I try to always look at what is the end result that's trying to be accomplished here, and it's to get the mortgage paid off faster. So like I said, nothing wrong with it, but there are more effective ways of accomplishing that same thing while maintaining or increasing that flexibility. So, for example, if you make extra mortgage payments and you were to lose your job, your mortgage company isn't going to say you don't need to make payments.
Right. Well, you gave us a little extra, so don't worry about the next few months. They're not going to say that.
No, they're not. And so with that said, assuming you have a low interest rate, because interest rates are low today,
yep,
and you invest the amount that you would have put towards the extra payments, and you're gaining a higher growth rate, well, then the math automatically says at some point the investment account is going to get bigger as long as your risk tolerance is high enough and you have it invested appropriately to make this math work over a long period of time. This isn't over 6 months, but over a long period of time.
Right, yeah.
If you've been investing that, at some point that investment account is going to exceed the value of what's left on your mortgage. So if you do that, you now have choice.
Right. Back to flexibility.
You can sell those assets that you built to pay off the mortgage. You'll have some capital gains to pay too. Or you can say, oh gosh, now that I have that and know I could do it, I'm going to keep that money and I'm just going to keep making my regular payments. But it's a much more effective way, assuming that over the long term, if we're talking a mortgage, maybe you have 20 years left, well, then you have to look at the investment return averaged over the next 20 years, or 15 if you're making it, since your goal is to make it happen early.
Got it. Amy, like so many other things we talk about, this really comes down to an individual situation, and there are just so many variables that go into a decision like this, and we kind of just scratched the surface on it over these last 15 minutes or so. If somebody wants to come talk to you at Thimbleberry about whether or not to pay off a mortgage or any questions related to their financial future in general, what are the best ways to find you?
They can give us a call at 503-610-6510 or send us a message through our website. There's a schedule a time to chat button.
And the website is?
Thimbleberryfinancial.com.
Great stuff as always, Amy. We'll talk again soon.
Sounds great, Jag.
Registered representative. Securities offered through Cambridge Investment Research, Inc., a broker-dealer, member FINRA SIPC. Investment advisor representative. Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Thimbleberry Financial are not affiliated.